Hello, and welcome back to another video. Today, I am going to be focusing on educating you on the basics of financial portfolios. I will be going over a variety of topics such as what a stock portfolio is, parts of a portfolio, what goes into creating a successful portfolio, and some things to consider when starting to develop your own portfolio. By the end of this video, you should have a basic understanding of what you need to create your own financial portfolio. Before we start getting into the individual parts of a stock portfolio, I would briefly like to start off by explaining what a stock portfolio is. In simple terms, a stock portfolio is a collection of different assets in an organized manner. The core assets of a portfolio are usually stocks, bonds, cash, and cash equivalents such as ETFs or closed-ended funds. Although stocks and bonds are usually the core aspects of the majority of portfolios, other assets can be included too. Assets such as art pieces, sports cars, real estate, cryptocurrencies, and vintage coins can all be considered assets and parts of someone's portfolio. There are multiple parts of a portfolio, and it's important to have a basic understanding. Let's now take a look at an example of a stock portfolio. This is the example portfolio that I'm going to be using to help you understand the parts of a stock portfolio. I found this portfolio on the internet from a site called Wallmine, which is a toolkit that investors use to analyze stocks and other investments. This is not an exemplary portfolio for you, but it's just to help visualize the different parts. The first column shown in the image is the symbol column. This is where the name or ticker of the investments are shown. These symbols below are called tickers. The column to the right shows the full name of the company. The price column usually displays the purchase price or the current price of the investments. The purchase price is what you bought the stock at. The change in percent is how much the stock price has increased or decreased after the market has opened. The cash increase/decrease is also shown beside it. The next column, titled Shares, displays the total shares that you purchased. In this example, 48 shares at Amazon were purchased. The next column, labeled Average Cost, is the mean price calculated over some period of time. The total cost is calculated by multiplying the purchase price by the numbers of shares purchased. Essentially, it's the total dollar amount that you paid to purchase the shares of the specific investment. The market value is the value of the purchased shares at the current price. Gain is the total gain or loss, and days gain is the total gain or loss for the day. Days gain is calculated using the days change, and total gain loss is calculated using the total gain/loss. Last but not least, the return is the total gain or loss in percentage form. These are the core parts to a stock portfolio. Now, let's take a look into what goes into creating a successful portfolio. In my opinion, I believe that there are 6 parts to creating a successful, diversified, and balanced stock portfolio. These parts include research, stocks, bonds, etc., asset allocation, diversification, rebalancing, and exchange-traded funds. As you get more invested in your stock portfolio, you will start to uncover more parts that will make your portfolio even more successful. But for now, I believe that these factors are the most vital in creating a stock portfolio. Moving forward, let's look at what these 6 parts mean and how you can implement these into your own portfolio. The first and most important part, in my opinion, to creating a balanced portfolio is to research. Especially when investing a large sum of money, it's important to have preliminary research before making a decision. Researching stocks can be quite overwhelming because there are often a lot of different opinions on whether you should buy, sell, or hold a stock. It can be hard to interpret different analysts' opinions, and often is just too much information to comprehend. It's important to keep your research focused on a few different things, such as how much money you're going to invest, what industry you're going to invest in, and is the industry volatile. Then you can start to research more specific things such as the company's financials, growth, and expert opinions. This way of researching will help you determine whether or not to invest in a company. Moving on to another important part of creating a successful portfolio is investing in stocks, bonds, and more. In almost every successful investment portfolio, there's a variety of stocks and bonds. Stocks and bonds both have a large impact on the success of an investor's portfolio. It's extremely important to research bonds and stocks before investing because they are never risk-free. Often, investors looking to generate passive income over a long period of time will add a variety of stocks and bonds to their portfolio. Although bonds do remain a mystery to some investors, it's important to put some money into them as they are not as volatile as stocks. If you have just stocks in your portfolio, you're at higher risk of losing all your money, but bonds help offset this risk. The third part to creating a successful portfolio is asset allocation. Asset allocation is a type of investment strategy that works towards maintaining the balance between risk and reward through allocating money into different assets based on the goals of the investor. Asset allocation also aims to build a portfolio with non-correlating assets. Asset allocation is thought to be one of the most important decisions an investor will make because it determines the outcomes of their earnings. When you're allocating assets, you need to first determine what your investment goals are. Are you planning to save up for that new car that came out, or maybe pay off your college debt, or generate income for your retirement? These are just a few investment objectives that will help shape how you go about allocating your assets. It's also important to recognize that your investment goals will change over time and you will eventually need to reallocate your assets based on your goals. Moving on to diversification, which is similar to asset allocation, but is focused on the makeup of your portfolio rather than focusing on your investment goals for the future. Diversification is a type of investment strategy that is used to help manage risk factors that come with investing in various assets. Because the stock markets are fairly unpredictable and subject to lots of change, there's a large risk associated with investing. But if you diversify, you are able to invest in different companies and assets that are not prone to the same risk. Diversifying does not just mean investing in different industries, but also investing in bonds, ETFs, large companies, small companies, etc. It's not all sunshine and rainbows because diversifying does reduce return and capital gain because you're not concentrating large sums of money into one company. Someone who puts their money into a limited number of investments may have a higher return than an investor who diversifies, yet more risk is associated when investing in a limited number of investments. The fifth part to creating a successful portfolio is rebalancing, which can sometimes be a confusing strategy to talk about, but it's important to understand as you get into investing. Because the market's performance is always changing, there is a need to rebalance your assets. By buying and selling assets periodically, investors are able to maintain or regain their proper asset allocation. Let's say your portfolio has 50% stocks and 50% bonds, and the stock prices rise. You would probably consider buying more stocks so your portfolio consists of maybe 70% stocks and 30% bonds. After the prices start to drop, you would have to rebalance again. This is why rebalancing is important, especially in an unpredictable market. Last but not least, a less important part to successful stock portfolios, yet still one to note down, exchange traded funds. If you are not familiar with what ETFs are, I suggest that you take a look at my Basics of Investing video where I dive deeper into the concept of index funds and ETFs. Since there are a variety of stocks offered in each ETF, it allows you to achieve diversification in a simple way. Rather than investing in 20 different stocks, you can invest in one ETF to promote your portfolio's diversification. Another benefit of investing in ETFs are that they are just as easy to buy and sell as other assets on the market. In other words, they have the same liquidity as other major assets. Although they are not too important in your portfolio, it's definitely worth considering adding some to your portfolio, especially as a beginner. To end off this video, I just want to give you a few tips to getting started on building your own stock portfolio. First of all, you need to talk with your parents about it because most firms will not let you create an investment account until you are of age. Your parents may already have an investment account set up to help fund your college education or for other reasons. If so, consider discussing making some of your own investments in that account with your own money. Also, many investment firms offer custodial accounts, which allow you to invest at a younger age but under your parents' name. The next tip is to do research, as it is one of the most important parts of investing. As you set up your portfolio, remember to keep the steps I suggested in mind. If you are not ready to invest real money, I highly suggest you try out a market simulator. I will link some good market simulators in the description. Once again, I hope you enjoyed this video and stay tuned for more in the future. Thank you.